Corporate Finance, Core Topic 8, Strategic Finance, Learning Objective number 4. We want to assess the financial impact of mergers and acquisitions, M&As. So first talk about mergers and acquisitions. What is a merger? A merger is the complete absorption of one firm by another, where the target firm ceases to exist. The target firm is the one that's acquired. So sometimes I'll talk about the acquirer and the target. The acquirer acquires the target firm has ceased to exist. A consolidation is also a merger. It's the same effect, but the new entity is created and both firms cease to exist. So two companies merge, form a new company, and the two existing company names go away. The results of either a merger or consolidation are the same, with the combining of assets and liabilities. And consolidations are often just called mergers as well. You can also acquire another firm just by buying their stock. So say I had enough money to buy all the stock of, say, Uber. I could just buy all their stock, and at some point I'm the majority stockholder. I am the owner of the company. So it's an alternative to a merger where you have to kind of get an agreement that we want to merge. And you could do that with an offer of cash or an exchange of stock. And the advantage of doing an acquisition of stock is you don't need to get management's approval, the target's approval. You could just do a hostile takeover and take over their firm just by buying up all their shares. So alternatives to mergers and acquisitions are simply joint ventures or strategic alliances. So two firms don't have to have an agreement to merge. If they want to take advantage of some of the synergies, they could just have agreements where they do, say, shared marketing or some kind of product placement, combining the two, or shared even production facilities. So you could have just joint ventures or strategic alliances as opposed to mergers and acquisitions. So why do a merger or acquisition? So here's a kind of a laundry list of reasons why you might want to do a merger, why you might want to take over another firm. You might want access to the target firm's technology or product. So that's the one I kind of hear the most about, is I just really want their products and technology to incorporate or sell. There might be marketing gains by buying the competitor. There's just marketing scale. If you have international marketing programs, and maybe just have a bigger company to sell larger product lines, that's better. Economies of scale in production. If there's any fixed cost in production, the more units you sell, the cheaper they get. So you just want to get bigger and bigger. There's vertical integration. So if you acquire, say, you acquire some supplier, you could get a more, maybe a cheaper, more reliable source of inputs. Another one is you might want to lever a target's capital structure to an optimal level. So this is more actually an investor's idea. I think this company is silly not to have debt. I think if this firm had debt and created an optimal capital structure, it would be more valuable. So I'm going to buy them, finance it with debt, and increase the value of that firm. And maybe I'll have these other good things associated with it also. Another reason is very similar to this. So why would you buy a company that has no debt? One is just to give them debt, because I think that'll be optimal capital structure. Another reason is maybe your firm has lots of debt. Your DDE ratio and coverage ratios are making it difficult for you to borrow. So if you acquire a firm with no debt, you get their assets without the debt, maybe issue stock to do it. You could delever the acquirer. And create more debt capacity, the ability to issue more debt in the future. You might also get a tax benefit from the target's unused tax carry forward losses. So a company that's been maybe losing money for many, many years no longer is able to get tax credits related to losses from past years. However, when you merge the two companies, the acquirer may be profitable. The target has several years of bad profits, and when you put them together, you see that, oh my goodness, I can just use those tax credits and save money in taxes next year. The combined companies may have reductions in CapEx or R&D or working capital due to shared resources. Related to that, the combined company may have reductions in overhead expenses. You only need one CFO to run. You don't need two CFOs. Maybe you only need one headquarters facility. Next one, you could increase the market power. So the idea is maybe ultimately maybe you're trying to increase prices and have more purchasing power over suppliers. So just becoming larger and becoming closer to a monopoly, you're going to have more market power, both with your customers and your suppliers. Diversification, if you put two companies together and maybe different business lines, you can lower your risk, lower your beta, maybe increase the value of your company. And then the last one is a reduction in wasteful or ineffective management, or a reduction of wastefulness or ineffective management. So the idea is you think all the managers are overpaid and don't do a great job, so I'll just take over your company and do a better job at it. So those are reasons why you want to do a merger. What I want to do now is talk about the financial impacts of a merger with the next couple slides, and then how would you determine the value of a merger. As an acquirer, how much value will I get from this merger? So the first thing I want to talk about is forecasting consolidated financial statements. So when the two firms come together, the acquirer plus the target, how do you actually combine the income statement and balance sheet? Well, the income statement is actually the easier one, because you're just going to combine, your sales and cost of goods sold and all else, everything else, and get down to your EBIT. As far as interest expense, you have to forecast, if there's any change in debt balances for the acquisition. So you might have some different interest expense. Taxes, you just get the combined company's tax rate. So it's really just combining the two. The only trick is maybe, for some of the reasons we mentioned in the last slide, if you think you could reduce the G&A when the companies come together, or reduce cost of goods sold due to some shared production facilities, you want to incorporate that into into a forecast of income statement, but it would actually just show up as far as the actual results. Now on the balance sheet, for your assets and liabilities, you're just going to combine them, right? You're just going to add receivables and payables and inventories and cash balances and debt. You're just going to add them together. Except when you combine the companies, you want to make sure you handle any transactions and make an adjustment. So for example, what if the acquirer used cash on hand to pay for the acquisition? Well, obviously that cash is going to go away. Or if the acquirer used debt to finance the business, you're going to show you're going to forecast that debt balance showing up due to the purchase. Goodwill. All right, so goodwill is another asset we haven't really talked about. So I should say these are assets less goodwill. Now goodwill is going to show up in the balance sheet when the companies combine, and what it's going to reflect is the difference between what you pay for the target and what its book value is, or sometimes fair market value. And that's going to report it as goodwill. So if you pay $20 million for a firm and had a book value of equity of $12 million, that $8 million is going to show up as goodwill on the balance sheet. As far as the number of shares, the acquirer's existing shares are going to increase only if you issue shares to purchase the other firm, or there's an exchange of shares. So that gives you an idea. And I just want to give you two examples of consolidation. And one is one in which the target is purchased using debt, and the other one is the target is purchased by an issuance of stock. And let's kind of see what happens to the balance sheet. So here's the example of a firm A acquires firm B for $18 million, and they're going to finance it with debt. So let's look at, and the target's book value of equity is $10 here. So here's the acquirer, the firm that acquired. Here's their working capital. So that would be their cash, accounts receivables, payables, inventory. Here are their fixed assets. There's no goodwill yet. So you have total assets, and the company has no debt. So we'll just say no liabilities, so working capital, payables will be up here. So it's a little bit modified balance sheet, just kind of combining working capital. So, and we have total equity and liabilities and equity. Notice the balance sheet balances, L&E is equal to total assets. Now the target firm, here's what their financial looked like before. So they have working capital and fixed assets of $10 million and $10 million of equity, so their balance sheet balances. And we've done a determination that the fair market value of all their assets and liabilities are equal to their book value. So in this case, again, there's no difference between our estimation of the fair market value of assets and liabilities to their current book value. So now the two firms come together in this column, this fourth column here, where it says consolidated firm A plus B. So in this example, notice I've just added the working capital of A plus B. So it goes from 4 plus 2 to 6. I've added the fixed assets of 6 plus 8. That's 24. Now, so those are just an addition. Now, goodwill. I'm paying $18 million, or the acquirer is going to pay $18 million for the firm that has a book value of 10. So I'm going to add that 8 as a goodwill asset. So notice that the assets are not just 20 plus 10. They're 20 plus 10 to combine, plus the $8 in goodwill. Now on the financing part, both companies in this example had no debt to begin with. The company is going to issue $18 million of debt to finance it, so the new consolidated will just reflect that. And notice that the equity, the acquirer had $20 million of equity. The target firm had $10 million of equity. All right. What's going to happen here is since the acquirer is not issuing any new stock to purchase it, we are effectively just having the same $20 million of the acquirer's equity. No additional equity when you combine them. All right, so you can think about this. Why does that look like that? It's like the company just paid $18 million to buy the firm's assets. So they didn't issue any new equity for it. They just paid $18 million to buy the firm's assets. So it's kind of like just like additional CapEx purchase that's financed with debt. However, let's look what would happen if they actually issued stock of $18 million to buy the firm. Total assets are the same from the last slide, but the only difference here is they've issued $18 million. So they had $20 million book value of equity before. They issued $18 million of stock. And so now the book value of equity of the combined firm is 38. And the number of shares of the acquirer would increase. You know, they've issued $18 million of stock, whatever the stock price paid would determine then the number of shares. And the last slide we'll talk about is how would you decide if it makes financial sense to acquire a firm? And that's simply going to be, you're going to do an NPV. So you're going to take the net present value discounted at WACC of the target's free cash flows of the firm. So you're just going to do a pro forma forecast of the free cash flows of the target. You're going to subtract out the net debt of the target, assuming we're using non-cash free working capital. And so this is really a valuation. If you look at this, you know, NPV of free cash flows minus net debt, it's really a valuation of the target. And then you're just going to subtract whatever you're going to pay for the company. So in the last example, is you paid $18 million for the company. Well, the question is the NPV of the free cash flows of the combined companies, say $19 million, and you're only going to pay $18 million. So you're going to create $1 million in net present value. So that's the value of the acquisition. And one minor adjustment to that, sometimes we like to do that on a per share basis. So if you look at the second method, just take the present value of free cash flows minus net debt and divide by the target shares outstanding. So that's basically your valuation of the target company, and subtract the actual target price or the offer price to buy the company. So you think it's worth $20 a share, and you've offered that company $18 a share. So you're gonna net $2 a share. So there's two ways of trying to think about valuation. One is on a per share basis, and the other one is just in dollars. Now, what discount rate should I use? How do I get the WACC? Well, the discount rate should reflect the risk of the target. So in other words, you should be using the beta of the target's industry, unless you're in the same industry. So you can probably use the home firm there, or home industry. But you want to also make sure that the capital structure, whatever D&E ratio you're using to come up with your WACC, you want to make sure that reflects the combined, or the actual acquisition or the combined capital structure of the company. So you could just think about it as I could use the acquirer's capital structure, and in the end, I'm going to maintain that capital structure. So that would be a common thing to do. Is I'm not going to I'm going to actually use the existing firm's capital structure. All right. So in this topic, we really just talked about the financial impacts of mergers and acquisitions and how to value them.